Hi, this is a homework rant. Professor Elizabeth Keating is going to walk you through a problem from the Introduction to Financial Accounting by Horngren, Sundem, Elliott, and Philbrick from the 11th edition, which has also got the same problems as the ones that are found in the second custom edition for Boston University. This video will look at the problem 3-31, and the goals and objectives here will be reviewing debits and credits, particularly those associated with the income statement and the retained earnings, and we're really going to be focusing on how to understand the steps in the closing process. Before we dig into the problem, I'd like to spend a little bit of time having us look and review the balance sheet equation and how debits and credits relate to them. So you'll remember the balance sheet equation is that assets equals liabilities plus equity. And so we need to come up with a system if we want to keep this equation in balance that's simple and easy. So we're going to think about if anything increases an asset, we will call that a debit. And one way of keeping the balance sheet equation in balance is to increase the other side of the equation by the same amount. So we're going to call increases to liabilities and equity credits. And in this way, debits equal credits. So if we've decided an increase in an asset is a debit, then a decrease in an asset must be the opposite, or a credit. And if we've decided that an increase to a liability or an equity account is a credit, a decrease in a liability or an equity account must be a debit. So now let's look a minute at the income statement. So the income statement is revenues minus expenses equals net income. And net income is then closed into the retained earnings account. And so when we record a revenue, it ultimately increases retained earnings and equity. And since an increase in equity is a credit, an increase to revenue must also be a credit. And if we record an expense, that decreases retained earnings and equity. And if we have decreases in equity, we call those debits. Therefore, when we record an expense, it must be a debit. So let's just review for a moment one really important account, which is the cash account, which is when we receive cash, cash goes up, and that's a debit. And when we pay out cash, that's a disbursement, it reduces cash, and that's a credit. And now on to homework problem 3-31. In 3-31, we're presented with a trial balance. It has information, and from there, we're to glean that information and develop an income statement and a balance sheet. When we go to look at it, the information that we have presented right here is a portion of it. What I've grabbed and put across the top are the three accounts presented that relate to the income statement. So they tell us revenues of $345, and there's a cost of sale of $165, and their operating expenses of $135. Now, if we remember our graphic, revenues have a credit balance, so I've written there on the credit side the revenues of $345, and the expenses have debit balances, so I've written in the cost of sale and the operating expenses those balances on the debit side. I've also taken the retained earnings from the listing there, that's 92. So now what you should know in the trial balance is the retained earnings account is the one account that's out of date. It is actually the opening balance in retained earnings, and that's because the various things that update the retained earnings balances, the revenues, the expenses, and the dividends, they have not yet been recorded into the retained earnings account. And so what we're going to be doing now is going through the process of making the revenues and expense accounts closed and updating the retained earnings account. The first account we're going to work on closing out is the revenue account. So it starts with a credit balance. In order to close the account, we need to put in the amount that's needed to bring the revenue account to zero. So in order to do that, we need to debit the revenue account by $345. Now, we need to make a credit. Where we're going to credit, what we're going to credit is the T account called Income Summary. And what you'll see is Income Summary is going to gather together all the amounts in the various revenue and expense categories together so that we can compute net income. So we now have both a debit and a credit of $345 sitting in the revenue account, so we can now draw a line, add those two things together, and come up with net an amount of 0 sitting in revenues. We'll now move to cost of sales. Sales presently has a debit balance of $165, so we're going to add to that count a credit of $165, and the offsetting entry will be a debit to Income Summary. So one way of thinking about it is essentially we've transferred the debit of $165 sitting into cost of sales and shifted it, that in $165, into a debit in Income Summary. So now we have $165 both as a debit and a credit in the cost of sales account. So we've now created a 0 balance in the cost of sales account, and we can close it out. We're going to follow an identical process with operating expenses. In order to bring the operating expense account down to 0, we're going to have to create a credit in the operating expense account and offset it with a debit to Income Summary, both of $135. So 135 in debits equals 135 in credits and operating expenses, and so we can now close out the operating expense count as well. We now transfer our focus to the Income Summary account, where we have the $345 in revenue and the two different expense items of $165 and $135. When we take revenues minus those two expense categories, we come up with a net amount of $45,000, which is the amount of net income we earned in this period. We're now going to move ahead and close out the Income Summary account by now putting a debit into Income Summary, and the offsetting credit is going to be recorded into retained earnings. We now have a $45,000 debit and a $45,000 credit in Income Summary. So the Income Summary account, which has just existed briefly, is now at 0. And now we can look at what's presently in retained earnings, which is we started with 92. We updated the retained earnings account with a credit of 45 for net income, and we now have the closing amount in the retained earnings account, which is 137. So this is what I wanted to cover for this problem. I'm not going to go through the other elements. So thank you very much for listening to this homework rant on problem 331.